From the reading, gold has finally broken above its 200-day moving average for the first time in more than 100 days. Many investors use that as a guide to identify bull and bear markets, but this is the third time in the past 5 years that gold has broken above its 200-day average after being below it for more than 100 days, and it has failed to hold above it. It turns out that gold has had 3 breakouts in 5 years a few other times, and a third one coincided with a multi-year bull market in the metal. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is currently 8:27 p.m. Central Time on Sunday night, and I'm recording this in preparation for the market day of October the 19th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So as you caught, hopefully, I am recording this on Sunday night instead of my usual, about 7 o'clock in the morning Central Time a.m. before the market opens. So there'll be a couple differences in this video from our usual routine, but I did want to go ahead and put this out. I won't be at my desk at the time I need to normally do this in the morning. So I wanted to go ahead and put out what I could, which is 95% of what I would anyhow. There was just a couple inputs that we would normally throw in at the very last minute. And indeed, most notably, that would be the morning report. We would look to see what the futures markets are doing in both the United States as well as overseas. So we'll skip right over that. I will go ahead and mention the macroeconomic reports for Monday. And in the United States, there's just really this FOMC member Lacker speaking, so pretty light in the U.S. Also, FOMC member Brainard speaking as well. So just a couple speeches out there, nothing in terms of our usual macroeconomic reports for tomorrow. On Tuesday, there will be housing starts and building permits. Another FOMC member Dudley, and then also Powell speaking, and then Fed Chair Yellen speaking. So we've got quite a slew of FOMC members speaking, but in terms of macroeconomic reports, just this housing data coming out on Tuesday. So that gets us started at the beginning of the week. In terms of current volatility, VIX continues to drop. We see the short-term VIX at 12.89. Skew continues, though, to be also elevated. IV percentiles getting even lower. Look at this, 15 for the S&P, 14 for the Russell and the NASDAQ, and then 16 for the Dow. No standard deviation moves were put in on any of the indices on Friday, though if you look back at the last couple weeks, we've had kind of what you would look at as a normal number of standard deviation moves, and yet you have to also account that all this was pretty much bullish. All the standard deviation moves across all 4 indices were pretty much always bullish. So we've not had any kind of significant down day to speak of in a while. And then in terms of the regular daily report, portfolio investor postures, IBD status is confirmed uptrend, accumulation distribution. The S&P improved half a notch to a B. NASDAQ still a D-. GMI index 3 out of 6 with a sell signal. That author remains in cash. Primary market condition has improved up a notch to weak bear, but obviously that's a long way from being in this kind of bullish confirmed uptrend that IBD has. So in terms of these mechanical signals, and you see also the stock charts, decision point, the short-term signals are up, but the intermediate and longer-term signals are still down, though some of them are getting pretty close to perhaps rolling up. The overall consensus of this all is that we're still in transition. You see also the intermediate term market posture, very bullish posture with an upslope sentiment, but a bearish cluster formation present. So there's definitely warning signs that you really can't be all bear all the time in all time frames, because that just is not supported yet, though these do continue to improve. They're certainly much better than they were showing a couple 3 weeks ago. Position sizing opinions both at the 100% level, so no warning signs there. We made mention of the intermediate term market posture a moment ago. The S&P and the Dow are both very bullish. NASDAQ is in the bullish category, and the Russell is the only one of the four that is in a bearish intermediate term market posture. Hedge warning status remains level 1. And you see with respect to the volatility based metrics, pretty clean here. We have had 2 distribution days on the S&P and 3 on the NASDAQ, and they've come in relatively quick order, but that level itself is not yet a warning status. What is a warning status is this skew. It's been elevated really all week, and this with the close on Friday was over a 135, which would be about an 11.8% probability of a 2 standard deviation move in the next 30 days. So keep in mind that this is all about perspective. While that might not sound horribly high to many of you, that's probably 5 to 6 times normal. So normal being probably a little over 2%. So this is a much elevated probability, but it also is a signal that doesn't necessarily follow through in the next day or two. Same thing with this bearish cluster formation I mentioned up here with the intermediate term market posture indicator. Both of these are intermediate indicators of likely bearishness coming back into the market, but they don't necessarily mean, in quotes, tomorrow. So just kind of keep that in mind. But it is interesting to see both of those flagging. In terms of New York Stock Exchange, new highs, new lows, pretty benign. I mean, obviously there was a lot more bullish, and certainly that is good sign for the bulls, but it wasn't over 300. Certainly in the ratio of new highs to new lows was very skewed, very bullish day indeed, and yet at the same time it wasn't that there were a lot of companies making new highs for the day. In terms of intermarket risk aversion indicators, so we've got 2 of them that are risk off and another couple that are really close to being either risk on or risk off. So these are also kind of finely balanced. In terms of special opinions, option income strategies, the VIX is within the acceptable window for novice traders. Consider reduced position size and the potential for higher than normal delta and vega moves given the current skew and that intermediate term bearish cluster formation. In terms of covered calls, we've tweaked this opinion a little bit. Conditions are cautiously bullish, acceptable to initiate new positions for novice traders. Suggest a 2-to-1 ratio of in the money versus out of the money strikes. And I should say that a little differently. Let's correct this. It's a 2-to-1 ratio, but the 2 would be out of the money and the 1 would be in the money. I'll have to get that corrected. So 2-to-1 ratio of out of the money versus in the money. Also a 2-to-1 ratio of higher beta versus lower beta. So this is starting to get more bullish than where we were a week or 2 weeks ago, and both in how we distribute the strikes, but also in how we distribute the high beta and low beta, and that's being reflected with these improving conditions. If you need to be more defensive or desire to be more defensive, consider legging in. Consider legging in through out of the money puts, or scale to the size that you're willing to own. So all those would be ways to be more defensive if you feel that that is appropriate. And then also with the outright put selling, consider scaling into positions, consider using defined risk positions such as spreading off that put instead of just being a naked put. And always have it in a position size that you are willing to truly own. And don't kid yourself about what that means to truly own that. So if the market were to pull back 2 standard deviations and all of a sudden you were to be challenged on those, are you willing to take ownership of those shares, the number of contracts that you have set up? That is the ultimate way to be able to handle those pullbacks, which will come if you are a put seller, and be able to do that without blinking. In terms of sector market posture, you can see green just about across the board in the short and intermediate term. Transportation, a little bit of weakness. Retail has certainly popped back up and is doing better after the really colossal 10 standard deviation down move by Walmart. In terms of percent change, you see just about everybody did green except for industrials, the lone one that was down as a sector for Friday. Also starting to see more green across the different time frames, so take note of that as well. 1 day, 5 day, 1 month, even into the 3 month on a couple of these sectors, most notably utilities. Starting to show, a little bit more persistence and not just a sea of red that we had there on those lower 4, even 5 time frames and not too distant past. So a couple things to kind of think about from that aspect as well. That should be enough for tonight. Again, normally we would, of course, be doing this in the morning prior to the market open. A little bit of an altered schedule today. If you find what we're doing is helpful to your trading, greatly appreciate your liking us on YouTube, subscribing to us on the YouTube channel, and then, of course, on the other aspects, retweet us to your Twitter followers, to your StockTwit followers, etc. Email support at falconglobaltraders.com. Disclaimers as always, hit the pause button if you need more time to review this, and we'll be back on our regular schedule Tuesday morning before the market opens with our regular Falcon Global market preview. Good trading.